You had a fabulous lunch. For the first time, we have completed within 2, and we are starting the session right at 2. So good. Welcome back once again for this seminar on real estate transactions. People, they often say that in West Bengal only one industry has grown up. This is real estate. So I hope so that professionals who are practicing in Calcutta, they have more opportunities in this sector, and that is the reason we are here. And we have renowned speakers with us, and I hope so that you had enjoyed the first session. And the second session would be dealt in by Vishnu Bagri. I would request Vishnu Bagri to please come forward and take his seat on the dais. A big round of applause for him. And I would request Kanchan Datto to please come forward and offer a flower bouquet to Vishnu Bagri. See, what I was discussing with C.A. Kanchan Datta just a few minutes back, that he has been regularly coming to our institute for attending seminars since last couple of Saturdays, and I can only say that for the next couple of Saturdays also we will be hosting some programs. So please join us and please get the knowledges for your own understandings and all. So I would go for a quick round of introduction for Vishnu. Vishnu, representing the younger generation, is a partner in Messrs. Sangvi, Dev and Unni, a chartered accountant firm in Bangalore. A graduate in commerce, a chartered accountant of 1999. He promoted a consulting venture in 2006. And now known as SDU Consulting Private Limited. He integrated his consulting practice with Messrs. Sangvi, Dev and Unni in 2011, and prior to that, he used to work as a global tax advisory services division of SR Batlibai and Company, and he is practicing in the field of direct taxes and brings strong credentials in the field of cross-border transactions and transfer pricing. He is also a faculty of the ICI certification course on international tax, and also speaks regularly on tax topics at various forums, and hopefully he is the first time in Calcutta. Okay, so let's welcome him with a big round of applause once again. And I would request all of you to make this session more interactive, vibrant, so that the speaker would get some good input from you all, the real-time problems that you have been facing, and you would be able to address those issues. Thank you very much.
Good afternoon. I don't know if that was loud and passionate as the earlier speaker. It's a post-lunch session, but I do want to do a few subtle remarks which is close to my heart, which is, it's a great honor for me to be here for various reasons. My Sasural and Nanyal is Calcutta, so it's not my first trip to Calcutta. And if any one of you bump into my in-laws or my Nanavadi people, just make sure you put in a good word for me. It's my biggest honor because I'm following up my partner, Mr. S. Venkatramani, whom you have heard. It's inspiring to be his partner and the passion he brings to the subject. I'll start with disclaimers. After listening to the first session and also preparing for this topic, one thing I realized is what I should do is I should keep the case laws away. So I have made an extremely high effort not to read any case laws. Okay, so I think the session today would basically be about all of you raising questions and hopefully within somebody amongst you giving us the answer to it. So I'm just going to be a facilitator in that sense. The topic of structuring real estate transactions, the way I look at it is more, and whenever I speak, at least so far, that's, the way I've looked at it, that I think we've just been privileged to, as a student of the subject, to, further our thoughts. And I was thinking about how I should take this topic. And obviously there are enough case laws, and I think real estate transactions probably will have the maximum judicial decisions. And I said that those are anyway post facto, and structuring a real estate transaction is pre facto, which is, on a lighter note, we are committing the sin, and it's subsequently to understand how we defend the sin. And structuring is about conducting business, right? And so what I'm attempted to do in this in this discussion is, sorry. I do not know if, okay. Huh? Okay. Sorry. Topic will be, in terms of who is the owner of what, and when is that what taxable. If you go back to your previous session, we have only spoken about, owner of what and when is the ownership of what transferred. The entire implications of real estate, all models, all structuring opportunities, all structuring issues. If you really think about it, this is the simplest sentence you can summarize it. Now, if you look at, who are the people involved in any real estate transaction? Broadly, you can categorize them into a landowner, a developer, which would include your contractors and construction participants, and your consumers or buyers of the final output. What is it which is being taxed? It's either the land, the building, or both, or the rights in the above. And the whole dilemma which is getting created in the market right now in terms of the tax issues is, when is that tax going to happen, right? And like Venkat mentioned in the earlier session, that it's really not that the issues is around the levy of tax itself. I think there's a lot of clarificatory points required, not only within a law but also amongst the laws, because the incidence of tax itself, the interpretation by different laws has been different. Some people are saying when you sign the agreement, there is a tax incidence. Some talk about possession, some delivery, some payment. And whether it's income tax, whether it's indirect taxes, I think the whole aspect of real estate transactions and the tax issues is in the same sentence, which I'll repeat, which is, who is the owner of what and when is the ownership of what transferred. The agenda now in this discussion is to try and facilitate our minds to look at what could we come up with in terms of alternative structures. So, it's very important to understand a few terms or concepts underlying this real estate thing. In the interest of time, I'm just going to, the slides will be shared with everyone. It's right now not part of the material, but it will be shared with everyone after the session. So these are concepts which are very worthwhile to note. What is property? Property is a right and an interest which is transferable, inheritable, and capable of being mortgaged. And this is a definition which we need to keep in mind when we are drafting contracts or visualizing structures. What is immovable property? While in the Transfer of Property Act, it's just been defined to say that it does not include standing timber, growing crops, or grass. But the General Clauses Act says that any benefits which arise out of land and things attached to earth is also land. Transfer of property, an act by which a living person conveys property in present or in future to one or more living persons or to himself and along with another living person. And living persons have been defined to include an individual, a company, an association of persons, or a body of individuals. Gift is the transfer of certain existing movable or immovable properties made voluntarily and without consideration by a donor to a donee. Now, these are concepts which really need to stick into our minds. I would encourage you all to just register, and the finer concepts which go into the Transfer of Property Act and when we evaluate any real estate agreements is, what is a right? It is something which enables a person to do or not to do something, right? What is a right in rem? The right in rem is the right in that property, okay, and it's a right in that property against the entire world. And what is right in personam? Right in personam is the right available against a particular person. Now, if you go back to the earlier discussion when we were talking about JDAs, etc., one of the issues in this is, does that result in a transfer of a property? So now the question is, in that agreement, is there a transfer of a right in rem, right, which in my mind would trigger tax incidences? Right in personam is a debatable point. Certain in the immovable property context, why this concept is extremely critical is, any right in an immovable property is also an immovable property, okay, and all the legislative provisions differentiate the incidence of tax for a movable property and an immovable property. So rights, the bundle of rights, if it is associated with an immovable property, so if it's a right in rem in a land, all forms of those rights would qualify as an immovable property. But right in personam is a contractual right. So let's say that there's a liquidated damages clause, right, for non-performance. Is that a right in rem or is that a right in personam? Any thoughts? Perfect. So, and that's really the opportunity to look at how we structure these agreements. That when we are looking at capital assets, right, when we are looking at the definition of capital asset, generally a rights in any or rights or interests would qualify as a capital asset. Now, in the contract, when there is some form of a transfer or an assignment which is being either visualized while structuring or in an assessment which the officer is claiming, what is that transfer? Is there been a transfer of a bundle of rights in the immovable property, or is that contractual relationship triggered an assignment of a right in personam? And this is gets even more sort of complex as we go into the transfer, and I'll discuss this in a little more length in the subsequent slides. What is ownership? Ownership is really the right in rem. It's because you say you're an owner of a property, right? So you're talking about your ownership in the context of that property. So all the bundle of rights, whether it's a right, and in the context of immovable property, it will be right to possess, to occupy, to develop, okay, to transfer, to gift, and there's also a residual right which you have, which is you have the right to do what it takes to protect the earlier rights. And the interesting part of law is that these rights, it's a bundle and you can also break them up. So you could actually have arrangements where you could say that the right which has been assigned or transferred is only the right to possess. Okay. At the same time, you could have a contract which says I have only assigned the right to develop. Now, you could assign the right to develop or you could license the right to develop. Right? I'm just laying the concepts. It's a post-lunch session. I just want these words to get into our minds and then look at some of the case studies and questions which will come up in the subsequent slides. So now we'll just go into a slightly business perspective of why these issues in real estate or structuring of real estate is important. The two main participants in this is the landowner who's taking the financial risk, is the landowner and the developer. The landowner is in need of a liquidity. It is relative. Somebody might want it today, somebody might want it tomorrow, somebody might want to wait for a higher return. And similarly, the developer needs liquidity. And both of their interests is that over a period of time, the value is going to go up. So can we participate in the value accretion? So the entire negotiation or structuring of a real estate transaction is really trying to address these two objectives of the landowner and the developer. That what is the business potential or the objective of the landowner? Does he want to encash now, right, or does he want to wait? And similarly, the building owner, can he actually build it, or does he need money to build it? And where will he source the money from? So if he needs to get the money in debt from a bank or from any other party, then he needs to show that he has security. Right? And if he needs security, then the negotiation he does in those contracts is to get more and more rights in the property so that the lender feels secure that this arrangement is going to be implemented, and if it goes wrong, there is a recourse which that person has. So while drafting the contracts on transfer, etc., it's very important to understand these objectives, because the interpretation of those contractual obligations would rely on what the negotiating objectives of those parties were. And I think sometimes in the boilerplate agreements, we are not being as sensitive to these points, and therefore, though a landowner or a builder may not have the objective of needing to raise loans or debt, but because we've used a standard contract, the implications are same to him as any other developer who would want rights so that he can have a lien to the property and raise debt from the banks. I'm again reiterating, who is the owner of what, and when is the ownership in what transferred. Now let's just celebrate this in the context of some basic agreements. Now let's start with an agreement to sell, and I request people from the audience to participate on these things. I'll just leave it as questions. So in an agreement to sell, what is being transferred? Any thoughts? Agreement to sell a land. Okay. So if I enter into an agreement to sell with you, and then I want to assign it to somebody. Can I assign it? So, right. So now at this stage, if we did assign it, there would be an assignment of a right. It's a right in rem, right? And we are talking about rights in that property which that agreement to deals with. So it is an assignment or a transfer of land. Okay. Similarly, now, so what is the difference between a sale deed and an agreement to sell? Sorry?
The property is already present. You're transferring the property.
Even in an agreement. So we are talking about the land. We have not yet started constructing. So the land is anyway there. Whether it was the date of the agreement to sell or it was the date of the sale deed. Perfect. So now the question is that the right to title is also one of the rights underlying the bundle of rights. Okay. Now in our current times, at least till now, most of the precedenting transactions in real estate have not tried to look at considerations of right to title independent of right to development, independent of right to possess, independent of right to develop. Right? Nobody has attempted because for business reasons. Obviously, tax is an after effect of a business conduct, right? And business, when anything new happens in an economy, the people whose money is involved in the transaction would like to secure themselves, and their lawyers would obviously draft agreements to get them the maximum security, right? But this concept is extremely important. This is evolving. It's already coming out in the other sectors, in the non-real estate sectors, where you have concepts like, if you take the IPL, they have probably monetized different forms of rights. It all started with the fact that they have a team, but look at the number of rights they were able to monetize. In the film industry, it started years back. They would differentiate the distribution rights from the production rights, right? So it's my personal view that these concepts are going to come into real estate, and you can see some of the commercial trends in that direction where people are asking, so developers are asking premium, right? Because they have a brand. Okay, they say that we want a premium to be entering into this JDA, right? And in the negotiation, they put that, saying that the fact that our brand is associated in this development project is actually getting a premium in the valuation when you sell it in the end. So these are, so in a very simple way, the transactions look very simple, like it's sale of land for money or sale of land for building. And similarly, from the developer side, it's either purchase of land or purchase of land for building. And the other thing is, if you're not transferring any ownership, then you're engaging the other guy to just construct, right? And the other guy is also saying, okay, give me money and I will construct it. So if you just let go of the L&T decision, right, it's actually not that complicated, right? If you let go of the L&T decision for a while and think about this, finally, in that land, what else will you do? You'll either construct a building, or you will say that, okay, I don't have the money, you construct the building and I'll give you the land. But the issue again comes back to, because of the legal agreements and the rights which are underlying those agreements, the issues arise because you're trying to question yourself, who is the owner of what? Who has the ownership on the building? Can the owners of the land and building be different? Anybody here who thinks it cannot be different? Sorry? Anybody here who thinks that the owners of the land and the building cannot be different? Sorry? Right? Right. Absolutely. So, and if we spend a little more time, we'll come up with a lot more examples. So fundamentally, we are now, all of us are visualizing this, saying that landowner owns the land, building owner owns the building. Now you start looking at breaking up the rights in this arrangement even further. Then you'll come up with tenancy rights, you'll come up with TDRs, you'll come up with the government regulated situations, the society structures which exist in Mumbai, right? Now, why are those rights part of the real estate transactions, or why do those rights trigger capital gains, right? One of the questions which was raised in the earlier thing was about TDRs, right? Because they provide you a right in the immovable property. It's a right in rem, and therefore it is a capital asset, and a transfer of a capital asset is liable to capital gains. And if you recall the earlier decisions of BC Srinivasa Shetty, etc., where basically if you are not able to determine the cost of acquisition, you are saying that it's not liable to tax, which has been plugged in the law by introducing the provision saying that you'll deem the cost of acquisition to be nil. But I think that's just some of the so-called evolution or innovation which happened in the past. But now again you could look at, can you differentiate agreements and say that the right to develop can be carved out independent of right to possess? And this is where, like I said, my intent is not to go to the judicial principles, okay? But, and I don't think there is a very clear decision, at least in my research which I have come across, which has very categorically tried to say that whether you can, bifurcate in an agreement and say, I'm giving the developer right to develop, I'm assigning my right to develop. So I will never own the building, the other person will own the building. But I'm not giving him a right to possess. So then, if you have to go into that debate, right, on I'm giving the right to develop, but I'm not giving the right to possess, how does that guy develop if he cannot possess the property? One school of thought. The other school of thought is, which is exactly, I would go with that school of thought, and senior professional from there had mentioned leasehold arrangements, right? So, what you're saying is, I am licensing the right to possess, but I'm assigning the right to develop. Okay, and I think this differentiation is very important to note. Because even in the JDA decisions, court decisions which have come out, I don't think the arguments have gone into trying to bifurcate these rights and see from a commercial point of view, the consideration was given for what. And therefore, again, I am re-emphasizing on the sentence, who is the owner of what? So, when you have entered a JDA, right, who is the owner of the land? The landowner is the owner. Who is the owner of the building? Any thoughts? In a JDA, in a joint development agreement. Is the developer the owner? Sorry?
Depending on the agreement.
Yeah, so that's the $1 million answer, which is that it depends on the agreement, right? And this is again, when we compartmentalize JDA, I think we are missing out on this finer point, that in the JDA, at what point in time the rights to develop have been assigned, have been transferred, versus at what point in time you have just given him permission to do it. And I think that's the difference between engaging a contractor and engaging a developer. And if you look at it economically, the entrepreneur versus a service provider. Okay, and then when you say when is the ownership transferred? So if I say that I have engaged a person to construct, I own a land, I have engaged a person to construct the building, right? Now he's constructed the building. The fact that he's constructed the building, does it mean that he is the owner of the building? Why? Because I have engaged him to provide a service. Now suppose I say in that contract, right, that in return for you constructing my house, I'll give you one flat. Does that change anything? Sure? So when does the assignment happen then? When does the transfer happen? So that is after the construction is over, I am entering into an agreement to sell or a sale deed, and I am getting it registered and saying, okay, I owed you so much money and in return I am giving you this much built up area, right? Now, why does, if at that point in time when I am giving the built up area, why do I need to give him a UDI?
Because the land, which is the superstructure, is situated on that. If I don't use, then it's not, he is only the owner of that superstructure, not the land,
Right.
on which it is kept.
So what happens hypothetically, we have sold this, I have sold, you are the contractor, I have given you that building, but I have not given you UDI, and I transfer the land to Venkat sir, okay?
Or you can say that unauthorized occupant.
So can Venkat sir sue you saying that, right? So this is the reason why the legal agreements are drafted in the way it is, that you have to protect the interest, though from a very contract, from a Transfer of Property Act point of view, you are the owner of the built up area. If you don't take the UDI interest, you will never be secured. Okay, because the rights in the court of law the landowner's rights would overshadow the rights of the developer. And to protect those kind of interests, we have the complex clauses which come in, and those complex clauses get interpreted in a certain way to create the LNTs of the world, or the LNT decisions of the world. Okay. So keeping these things in mind, like I said, this session is going to be very different from the previous session, because we're not going to discuss case laws. We are probably going to lay the seeds of the next case laws. Okay. So income never arises from a tax structure. I think it's very important to understand. In a healthy discussion, like I said, I'm going to refer to Venkat sir times, because I've had several arguments with him. So there's an interesting principle we have developed together in our office. Law applied to facts is interpretation. Law applied to facts is interpretation. Facts applied to law is probably manipulation. Okay? And manipulation. Okay? So no tax structures create business. Tax cannot create business. Tax always follows business. So it's really, when you're looking at advising, I think the difference on doing structuring projects and the thin line between you structuring for tax optimization versus manipulation, right, is really the factors, right? Look at tax as a cost of business. Just like how you would say that I will contract with this contractor because the cost which he is providing me is lower. So I'm looking at arranging my business in a manner so that my cost of tax is lower. So you're always underlying the transaction decision. You're not making tax the top priority, and that's very critical in the coming times. Okay, and therefore now, frankly, in terms of tax optimization concepts under the current law, if there is income, you cannot do away. You cannot say that you will not have tax. If you want to be within the legal frame, right? Now the issue is, or what is optimization or planning? I think primarily planning or optimization in any transaction, not only real estate, is primarily deferring the tax incidence. I think more than optimization, sometimes it's a survival point, and like we saw in the previous session, which is if you're made to pay huge taxes before you have realized the gains, right? It's a killer, right? And that's what you want to do when you're structuring. You want to try and ensure that the tax incidence is very close to the economic trigger, or the not economic trigger, the real realization, and it's not just dependent on an accounting entry or a economic trigger. Yes, from an economic principle, the developer has started working, so there is value which is going up, this brand has come in, but I don't have cash, so how do I pay tax, right? And so when you're looking at structures, we need to keep in mind that it's not about avoiding the tax. I think there's great value in deferring the tax incidence. Then you obviously have certain exemptions and reliefs in the law, which you can consider, and I'm sure most of you would be aware of the individual tax related, reinvestment in residential properties, how to go around those kind of things. I think a very critical concept which we somehow do not give enough attention to is that when we are looking at structuring agreements or structuring or advising on real estate transactions, have we looked at it in the context of the income earner, the SSE? What makes sense? What characterization of income? Business income or capital gains? It's not obvious. Okay, and it's not obvious, and as we go through this session, I'll come up with a few examples to say that it is not obvious. And I agree with you that most of the time we tend to conclude that. So I think from the builder's point of view, because of evolved precedences, we all go with business income and we go with percentage of completion. Now with the ICDS coming in, we don't have a choice. But for the landowner, there's not enough of thought being applied. Is it business income or not? Now, if he is a high net worth individual and he is going on purchasing land and making plotted plots and selling them, right? If he's doing that kind of stuff, I think he has all the criteria which qualify as business income, right? Now, whether that results in the most optimal result, that also we'll see. So, recognition of sale value, percentage of completion versus transfer. Now, look at a landowner. If you took the position that he is not engaged in business, right? I mean, we can litigate. I'm not concluding that the most prominent view is that JDA triggers an income tax or a capital gains tax at the time of signing of the agreement. That's the more, view which the officers are taking, and there are, at least in Karnataka, there are a few decisions which are in support of that. That I'm not saying that's the law of the land. It's yet High Court decisions, and each of those decisions have a certain fact pattern, right? But the default sort of view is that, ask the landowner to pay the tax at the signing of the JDA to avoid too much of litigation and issues at the assessment. If liquidity is a point, right, then you might want to consider it like, can you restructure this to see if he is into a JDA, can percentage of completion be considered? Okay. Cost reductions, cost of acquisition versus business expenses. The law defines what you can deduct in capital gains computation. Business expenses might be easier. Payment of tax, immediate versus deferred. If you treat the land converted into stock in trade, you defer the tax. Okay, so these are criteria. That's why I said that it's not, you have to look at it in the context of that specific taxpayer, what his objectives are, and then decide, what could be a good structure for him. Preferential rate for long-term capital gains, right? Why would you want to defer, right? Because in a JDA, the tax which you pay on the sale of the built-up area is short-term capital gains, right? Because you typically would not, after getting the built-up area, hold it for another 3 years, right? So, how do you look at valuations and how you look at the payment of tax to take advantage of the lower rate for long-term capital gains, right? Sometimes, if liquidity is not an issue, right, there's no harm in paying a higher value on the JDA, value your land higher than the stamp duty valuation. See, valuation is an extremely subjective area. Okay, and if you look at it from an economic perspective, the value of land is typically higher than what the stamp duty value is. Right? If you look at a commercial deal, right, because you factor in so many other parameters, right? For example, what is the kind of project for which you are engaging? What's the quality of the builder with whom you are associating? What is the extent of refundable deposits you have got or non-refundable deposits you have got? There are various parameters which go into that negotiation. And if liquidity is not an issue, you are probably on an overall basis, even if you followed the conservative view of paying taxes upon signing of the JDA, playing with valuation and paying a long-term capital gains would give you, in cumulative terms, better returns than trying to argue that I have not triggered the tax. Okay. Loss set off, current year losses versus brought forward losses. So, business loss of the current year can be set off against short-term capital gains or capital gains, right? And then another aspect to be kept in mind, that especially if you have corporates, etc., who have, who have been in business for a while now, but businesses are going down and they are incurring business losses, they want to unlock the value of the land, right? So, this could be an important parameter to keep in mind. Then you use special purpose vehicles, which is the significant part of today's agenda in terms of how SPVs make a difference and how LLPs have to be used. Layers of taxation, which is, you pay tax on the transaction itself, right? But if you are a corporate entity, you pay tax at the transaction, and then when you want to repatriate the money, there's another layer of tax, okay, which is a dividend distribution tax. Similarly, clubbing of income provisions need to be kept in mind, especially when we are looking at individual landowners or builders who want to transfer built-up area to their family members. Any comments, questions, ideas? Okay. So, these are some guiding observations. Income will trigger. If income doesn't trigger, we are wasting our time, right? Income has to trigger. Okay. It's merely the point of trigger which is deferred, which is what I said. The key really is to ensure that the tax trigger proximates with the realization of gains rather than the mere accounting or the economic trigger. And the subjectivity is higher because economic accretions are typically taxed in law prior to its actual realization, which is the whole issue of the valuation which we are talking about, right? That the value, right? Sometime I at least in my mind, whenever somebody talks about valuation, the sentence which comes to my mind is, beauty lies in the eye of the beholder. Right? So valuation for me is something like that. It's really so subjective that you really do not know. You can probably substantiate any sort of negotiation on that. Transfer definition and revenue recognition are concepts which are causing this, and I think this is sort of something which even the ICDS, after taking so much time, has not taken into consideration. I think the legislature should have realized that the current system in which we operate, right, we have not yet matured into an economy where the conversion of an economic gain to actual cash is short. There's a fair leg of time which transpires between you perceiving value versus you realizing value, right? We're yet in that phase, and our laws seem to be giving importance to economic concepts, right, without even clarifying it. And because they're not clarifying how they want to implement economic concepts, the whole litigation environment triggers, right? And therefore the issue of the definition of transfer, or there'll be enough issues coming up with the revenue recognition. We discussed the liquidity versus long-term capital gains. It's highly recommended to substantiate that whatever you're thinking has substance and it's triggered from business, that there's consistency between buyer and seller representations. We have come across quite a few situations where coincidentally we realized the officer has actually gone and done a search at the seller side, picked up an agreement, and then come towards the buyer side and seen that, both the agreements are different. Right? It's extremely risky. If not, it's totally wrong in my mind, and I think if anybody wants to take that risk also, I think it's not advisable. Alignment of positions adopted with allied regulations. So what is the position we are taking when it comes to works contract tax is a very critical element in telling what arguments you take on the incidence of tax for income tax. And similarly stamp duty. I'm not an expert on those laws, but I think real estate is one sector, right, which the consideration of allied laws is the highest, because there's so many laws which affect it. Urban Sealing Act, your local some regulations will be there. Sometimes society charter documents make a difference, right? There's also one more thing which I want to make note of. There's one common sort of planning structure which people have used over the years, but I'm not sure if it's the most optimal one. They set up a private limited company. The private limited company owns the land, and they transfer the shares of the company. That's how real estate transactions are dealt with using the private limited company. What is being missed out in that is that the cost step up is actually happening in the shares, and you're actually not looking at the cost being attributed to the immovable property. So from tomorrow, whenever you want to unlock that land from that corporate entity, right, you're actually landing up from an economic, if you're looking at it from if all of us cared for each other's money and we are one family, then we are paying double tax on the same income. Because to just explain that, if let's say sir here has a private limited company in which he owns a land, he sells that shares to me, right? Now if he's selling the shares, the valuation of the shares, he's obviously going to consider the land which he's got in that company. So I will pay him a premium. The premium is actually for what? It's for the land. But so that's gone. What is the cost of acquisition for the land? It remains the same. But where is that money which I paid to him gone into? It's become the cost of the shares, right? Now on that land, tomorrow I want to do a project, right? And if I want to do a project, I want to move this land. I want to unlock this land into that arrangement. So that gives me flexibility, because the company also has a limitation of dividend distribution tax, right? So how do I go about that? Okay, so I will want to migrate that land. When I migrate that land, and I'll say that, I just paid him, let's say I purchased it at 10 rupees and paid him, he purchased it at 10 and I paid him 100. I'm like, कल ही तो 100 रुपया का land 100 रुपया में बेच रहा हूँ, where is the tax? There is a tax again on 90, because the cost of acquisition is not on the land which you paid to. And this is a very important point to be kept in mind, because I think conventionally the private limited company has been used quite significantly in owning land, but I'm not sure with, and especially with the current situations, if it's really a recommended format to go. I'm not going to get too detailed into these, but these are sections which we should watch for. The definite.
About the stamp duty.
Correct.
Because used for that.
Yes.
Originally.
Yes.
Now this, because of the rise in the cost, this problem is coming.
Correct.
There is one more point of the act where you cannot hold the stamp duty.
Correct.
But the cost of the land remains the same.
Yes.
Now, because the cost of land has shoot up, so that cost is not coming. Because of that.
Yeah, so if you do the arithmetics, actually it would have been worthwhile paying the stamp duty.
This urban lands.
I take that point. Yeah, that's why I said allied laws has a thing. But even in that, I'm not an expert here, but I think even in your urban sealing, you could look at some other entity formats. You don't have to be a private limited company. There are sections which we need to watch out for. Obviously, the definition of section 247 on transfer. I'm going to spend a few minutes on that shortly. Section 43 CA, which was introduced a couple of years back, which is that if land or building is transferred, which is stock in trade, the valuation has to be at par with stamp duty. 50C, 50D is a very interesting one. Again, there were some questions on valuation, etc. I yet need to reach the situation where item without reading it, so I'm going to take the help of the book to read that section, because in my mind that's one more provision which we are missing out when we are looking at real estate transactions, and it could have significant impact, especially if I have to think about if the Supreme Court principles in L&T has to be applied, because it's a Supreme Court decision, right? The principles what they are saying could also be imposed under income tax. Okay. It says where the consideration received or accruing as a result of the transfer of a capital asset by an SSE is not ascertainable or cannot be determined, then for the purpose of computing income chargeable to tax as capital gains, the fair market value of the said asset on the date of transfer shall be deemed to be the full value of consideration received or accruing as a result of such transfer. Okay, and fair market value is again being defined in law, which is the value, in simple words, the value which it fetches in the open market. Right. So, if we go down this route of trying to bifurcate and say that apply this principle of accretion and say that something has got transferred, but the value of that is not ascertainable, I think 50D could be triggered. So, aligning the structures, keeping both the laws in mind would be quite interesting. Section 5627, which is the gift thing, where an individual receives anything without consideration, it could be taxed in their hands. TDS 194IA. This is another very important one, because again it goes back to having the bona fides of how you represent, right? So we've had situations where in a real estate transaction, right, basically the buyer deducted tax under 194IA. So the assessing officer computed the value working backwards, that you've put in so much, you've remitted so much TDS. So gross it up, and this is the value of the land, and it's gone to the seller and seen if they have considered the same value. Okay. Then you have AIR information and tax return reporting, right? So today with technology and these provisions, information being accessed by officers is quite easy. And more than that, I think they have the bank of SSE. So they obviously speak to one competitor and get the market valuation of the other competitor. So the information is available to them. So that gives you further onus on the consultants and the advisors to look at how has that transaction been structured. As auditors, are all the facts really disclosed? And maybe these are audit tests which even we need to consider when we are clearing some of those things.
Excuse me. Can you clarify more on the TDS part of the agreements? When an agreement is signed between a landowner and a developer, the TDS aspect of it.
Sure. So it can be a session in itself. So I'm just going to take 3 minutes to just, I guess you're asking me the question so you know the issue. I don't think there's a...
I really don't know about it, but I know it's very complicated, but just in a gist, if you could summarize,
Sure.
it would be helpful.
Okay, so the section basically says that any person being a transferee responsible for paying to a resident transferor any sum by way of consideration for transfer of any immovable property shall at the time of credit or payment, deduct tax. The issue with this is that when there is a simple sale deed, right, you know that this is the time of credit or the time of payment. In a JDA, where is the time of credit? So there's actually a school of thought that does 194IA actually apply to a joint development agreement? Any thoughts? Because on joint development agreement,
So property is not happening, so 194I is not happening.
but transfer of property is happening, because transfer definition will go to 247, and if I go by the high court decisions in Bombay and Karnataka, upon signing of the JDA, transfer has happened.
can come out of business, I mean, academic business, then only that reason there will not be any capital as
Right. I'm looking at it this way. That does the developer need to deduct tax for the land which he is getting? Right. So it's a difficult one, right? I mean, you don't have a credit entry. How do you deduct tax? Okay. I think we've been advising our clients to deduct tax based on the percentage of completion. I mean, the way they are recording the built-up area costs which they have incurred. So there's a valuation which you attach based on that to the land which you have, purchased. So we are recommending that based on your construction cost, compute the value of the land and deduct the TDS. And the reason we are doing this is just a conservative view. I think there are merits in the interpretation, but from a practical point of view, right? You don't want to get to the wrong side in a subjective area. You don't want to lose out on more points with the officer from starting itself, right? Because there is anyway a credit which you will get. I mean, the TDS is something which you can either claim as a refund or get it adjusted. But if because of lack of TDS something goes wrong, the developer's in a withholding tax assessment, he gets his issues get raked up. He's liable to pay interest, penalty, etc. And that results into opening, in my language, a Pandora's box. I mean, you're giving him more and more ammunition to dig into the entire transaction. So that is the key issue in 194IA is really this JDA, right? And then you have issues about how do you determine the valuation. So it says that for value exceeding, so on what value to deduct TDS? Okay. So similarly, buyers of apartments, etc. have to deduct TDS. At what value? Should it be just the value of the land and building? Should it include stamp duty? Should it include other facility costs? Right. So at least as a firm, we've been taking the view that you should look at the gross value, and it's just a conservative view we are taking because it's a TDS provision. But at an academic level, I can tell you that those issues exist. That on what value will you deduct the TDS? So JDA was one complication. Now I'm talking about a buyer, a consumer who's buying an apartment. He's also supposed to deduct TDS if the value exceeds 50 lakhs. Now on what is the value he needs to consider, or he or she needs to consider? Is it only the agreement value? Is it agreement value plus stamp duty, or there could be some other costs which get added during the process, like parking lot costs, right? Use of facilities. Okay, so these are kind of dimensions which are coming up.
But just to interrupt, like, if I sign a JD agreement tomorrow and give 2 crores as a premium money and 2 crores as an adjustable deposit money, so what should be my TDS reduction at that point?
I would yet think that you should go by the valuation of the land. So the landowner. So I will take a few minutes to discuss the JDA taxation and my views on it. But if I go by the conservative view, so when you have signed the JDA, the landowner is liable to pay tax. So you have to anyway do a valuation. Now either you could do a valuation based on the estimated cost of construction of the built up area which you're getting in return. That could be the value, which cannot be lower than the guidance value under 50C, right? So on that value, I would recommend deduction of tax.
Sir, but in case of transfer of right or lease property, whether the section is applicable?
Sorry?
In case of any lease property, suppose I am living on lease for 50 years, so then this section 194 is applicable?
If in that context of your lease arrangement, if transfer has happened,
Yeah, transfer, I am transferring for 50 years.
yes, so then it will apply. Because the language used in 194IA is transfer of immovable property.
Here we have another some similar, they have taken the view only in case of transfer, not in case of lease. Only in case of.
Yeah, see, even in lease, there are two things, right? I mean, I lease the land to you and you build the thing. So in that case, it's really not a transfer of the land, right? That's why I said, what is the structure or the agreement which will be there. So in that 50 years lease, typically what will happen is the land is leased and the other person is building it. So actually there is no transfer of land. So the interpretation is the same as what you would do for 247. I mean, the only point which I am trying to make is that your arguments on 194IA on transfer will have to be, similar to the positions you are taking under 247. So before I go into the SPV, yeah. No, value of the land. Yeah. So basically what we are saying is that the value of the land is realized through a deposit, through this, through that. So those are like payment terms. I mean, it's not that it's the value of the land plus the deposit.